If you keep up with current events and the news, you know that the Fed is going to be increasing and has increased already, has approved rate increases for interest rates. Interest rates are going up. But what does that actually mean in daily life? How does it affect you as a federal employee, especially as you're planning for or moving into retirement? We're going to talk about all that today. If you're new here, my name is Dallin Hawes, a financial planner serving you guys, helping you guys retire comfortable, confident, get the most out of your benefits, and now the other finance things in between. So we're going to dive right in. So one obvious thing that higher interest rates are going to affect are things like mortgages, loans, credit cards, student loans, basically anything with an interest rate that you're going to be paying. Well, guess what? Interest rates are going up. So if you're going to refinance, well, you're going to have to do it at a higher rate. So if you're buying a home, trying to refinance your home, it's going to cost you more to do so, right? If you already locked down a lower rate, well, then that's locked in and you're good to go. So when it comes to then credit cards, student loans, it's going to be more precarious, right? Rates are going to be higher, so you want to be more careful and you want to make sure you understand the rate. For example, if you get a car loan, it's not going to be as cheap to do so, right? Now, let me make one point here. We don't know exactly how fast and how high the Fed is going to raise interest rates this year, right? They've made a few announcements of, okay, this is kind of what their plans are, but in practice, we'll see, because especially with inflation the way it is right now, they could change their plans basically at any point, right? But they're planning to increase rates at least a couple percentage points here over the next 12 months. So we'll see how it actually plays out in practice. So what else does this affect? Well, there's good news, right? Things like high yield savings accounts or CDs or even the G fund are actually going to be earning more because interest rates are higher, right? So that's good news. So money that's sitting around in a CD, high yield savings account, those sort of things, you're going to earn more. Now, depending on how high interest rates go, it may not be that much, but it will increase, right? So that is good news because especially recently, the G fund, for example, has returned next to nothing, right? It is safe, but it doesn't return much. Now, higher interest rates is not going to mean the G fund's going to be like the stock market by any means, but it may raise the return by a couple percentage points a year, which for safe money, hey, you can't complain about that. But we have to ask ourselves okay, why is the Fed raising interest rates, right? And their goal is to slow inflation, right? If many of you might remember that back in the early 80s, inflation was rampant. It was crazy. So what did the Fed do? Well, they took a very extreme measure to stop it. They raised interest rates to above 20%, right? So interest rates were incredibly high. And guess what? It worked and it fixed inflation. Inflation slowed down dramatically. So what the Fed is trying to do is raise interest rates incrementally to slow down prices because prices have been rising very, very quickly. So, for example, in a real life situation, if interest rates go up, well, then that means mortgage rates are going to go up as well. So it takes more money to buy the same house that it did before. So what's that going to do to the housing market? Well, it will most likely slow it down some. Well, it may not do it much. It's hard to know because right now there's a huge demand for houses, right? And so it may not slow it down much, but ideally, it'll bring the cost down some. We'll see how that actually plays out in real life, but that is the idea in principle. So over time, higher interest rates supposedly, obviously right now, is kind of a strange situation with shortages, whether it is China shutting down because of another outbreak, whether it's the war in Ukraine. There's other factors here that are playing into the rising prices. It's not just low interest rates that have, led to higher prices, other factors. So we'll see how quickly we're going to see any results. It may be minimal and it may take a while, right? We'll see. We don't really know. But in the short term, yeah, mortgages are going to go up. The G fund's probably going to return a little more. Those are the things that are probably going to hit sooner rather than later. And then other things are going to come through like, okay, yeah, you will earn more in a high yield savings account and things like that as this progresses. Again, we'll see how fast the Fed actually raises rates, how fast they implement things. So that will certainly affect how quickly inflation potentially comes back and things like that. So I hope that was helpful. Again, as this develops, I'll be right here on the channel to kind of show you like, okay, this is what has happened and this is what it's going to mean for you. I'm going to be able to walk you through all the updates as they happen, but I hope that was helpful. Have an incredible rest of your day, and I'll see you next time.